All right, welcome to The Explainer. Today we are digging into something truly wild, a massive stock surge. We're going to break down how the pros read the charts to make sense of all that chaos. Okay, let's just jump right in with a number that had everybody's jaw on the floor. A stock went up over 173% in one day. No, that's not a typo. A move like that can literally make or break fortunes in just a few hours. So, when you see a move this explosive, it brings up the biggest question, right? For anyone watching, you have to ask, is this a rocket ship I need to jump on? Or is this whole thing just a house of cards about to come crashing down? So to get some answers, we're going to go inside the actual technical analysis report for a company called Republic Power Group Limited, or RPGL. And what's cool is, this report is from January 30th, 2026, the exact day of the breakout. So we're getting a perfect, real-time look at how analysts figure this stuff out as it's happening. All right, let's start digging. When a stock price just explodes like this, the very first place analysts look for clues is the trading volume. It's the key, It helps them separate what's a real signal from just random market noise. And wow, the force behind this thing was just immense. On the day of the breakout, the trading volume was more than 8.5 times normal. Think about that. This wasn't just a few people trading back and forth. This was a stampede. It tells you there's huge, maybe even institutional level interest here. Okay, so we've got this huge price jump on insane volume. The next question is, okay, but does this really change the big picture? To figure that out, analysts turn to a key tool called a moving average. You can kind of think of it like the stock's financial center of gravity, It shows you the long-term trend. And this is where it gets really interesting. Look at this. Before this day, the stock was just kind of bumping along in the 40-cent range, way below its average prices. But with this one move to 88 cents, it didn't just cross those averages, it absolutely shattered them. This is a huge signal. It's telling us there's been a major structural shift from a bearish downward trend to a brand new powerful bullish one. Okay, so a new trend is here. We've established that. But is it strong? Or is it just a flash in the pan that's going to run out of steam? To answer that, we've got to measure its momentum. And the data here is screaming strength. A whole bunch of these trend indicators are just flashing bright green. You've got the Arun indicator at a perfect 100. That confirms the stock is hitting new highs. Then there's another one, the parabolic SAR, giving a crystal clear buy signal. Put it all together, and it's painting a picture of a brand new trend with some serious force behind it. Then we have the RSI, the Relative Strength Index. I like to think of it as the stock's fuel gauge, and that gauge is reading 66.26. That's high, for sure, which confirms there's a ton of buying pressure. But, and this is super important, it's not in the red zone yet, above 70. This is a really key detail. It suggests that even though this engine is running hot, there might still be some fuel left in the tank. And, just to top it all off, the MACD, which is one of the most popular momentum indicators out there, has just flashed what's called a bullish crossover. It's like every single light on the dashboard is green now. Everything is telling us the engine of this new trend is running really, really strong. But every story has two sides, right? After a crazy move like this, the biggest question has to be about the risk. Can a stock actually move too far, too fast? Well, the short answer is absolutely. There's always gravity in the market. And the first big red flag is just how far the price has stretched, kind of like a rubber band, away from its normal trading range in such a short period of time. So to measure this, analysts use a tool called Bollinger Bands. The easiest way to think about them is like guardrails on a highway. Normally, you expect the price to stay driving pretty safely between them, within its normal range. But take a look at this. The upper guardrail was sitting at 74 cents. The price didn't just tap it. At 88 cents, it completely blew right through it. When a stock gets this far outside its normal lane, traders call it overextended. And that's usually a really strong signal that some kind of pullback or at least a cooling off period is probably coming. And this risk is backed up by another indicator, the Money Flow Index. It's at a staggering 98.90 out of 100. That basically suggests that pretty much everyone who wanted to buy this thing has already bought it. And what happens when there are no new buyers left? Well, it gets a lot harder for the price to keep going up. Okay, so after looking at all the clues, the good, the bad, and the just plain volatile, what's the final verdict? How does an analyst take all this information and turn it into an actual strategy?
Well, first off, the report's main conclusion is crystal clear. This isn't just some random spike. They call it a massive bottom breakout. That combination of the price move and that insane volume tells analysts that this is a huge, structurally significant event. It's something that has fundamentally changed the direction of this stock.
So the final verdict really boils down to a battle between two powerful forces. On one hand, you have the bull case, which is just undeniable. That breakout power and all the momentum signals are incredibly positive. But then you have the bear case, which is a really important warning sign. The stock is stretched, the buyers might be all tapped out, and a short-term cool-off seems very, very likely. With all that in mind, the analysts then lay out a new roadmap, the key levels to watch. You've got a major floor, a support level, down at 35 cents. Then there's the critical pivot point. This is the level the stock absolutely has to hold to stay bullish, and that's at 87 cents. And the next big target to the upside, the resistance, is at $1.40. So all of this leads to a pretty clear three-part strategy. 1, the outlook. It's bullish, plain and simple, as long as the price stays above that 87-cent pivot. 2, the target. The next logical place it could go is $1.40. But 3, and this part is crucial, the caution. Because the move was so straight up, a safer way to play it might be to wait for the price to pull back and retest a lower level. And that's what's so fascinating about this kind of analysis. The data tells us a really powerful story of what just happened. It lays out the bull case, the bear case, and a clear roadmap of what to watch for next. But at the end of the day, it's a great reminder that the market story is never really over. The next chapter is always waiting to be written.